Howdy there, folks. Welcome into today's video. This is a big one. Basically, this video is saying that stocks are going to crash 50% by the end of 2022. Now, this is from a YouTuber that I really respect in terms of a lot of their real estate data. They've been given a lot of good real estate data out there for the past 6 to 12 months or so. And so I watch a lot of their content, but I got this one suggested to me, so I thought this one was interesting. So I thought we'd react to this one, stocks to crash 50% by the end of 2022. Now, first off, that just goes to show you how almost cocky the stock market is right now, because no one would ever predict that the market's going to go down 50%, over a 4-month span, or 50%, even over a 6-month span or 12-month span. Like, that's not usually predictions folks make, right? But the stock market is at such a time where folks are feeling so confident with their predictions around a crash and these sorts of things that people throw these sorts of things out there. Oh, the market's going to go down 50%. Like, I don't think folks understand like what it takes to get the market down 50% and what type of actual devastation it takes to get the market. We got the market down 50. Keep in mind, the market's already down significantly. If you're talking about another 50% drop, we're talking that would be way worse than 2008, 2009, when countless banks were failing. The entire financial system basically almost went under, and the government had to save it. And so that's a big prediction. That's all I'm going to say about that. It's a very big prediction. We'll talk about the points they're going to make here and give my points. I appreciate every single one of you guys joining here for the new channel. We're over 8,000 subscribers at this point. It's absolutely crazy, man. I appreciate it, guys. Much love as always. And let me know your opinion. We'll get into this.
Stock market crashed by 50% by the end of 2022. Well, that's what the data is starting to say, because there's two key trends going on right now in both the stock market and the economy that are very concerning. Number one is that we have a grossly inflated and overvalued stock market. Number two is we are entering a recession where companies are going to lay off.
Okay, so that part is very important. We get to the details. So what are we valuing the stock market to make a assumption or prediction or an opinion that the stock market is massively overvalued?
And their earnings are going to decline. And today I have a special guest on this channel, an expert on the stock market and the economy, who's going to give us his insights on how much stock prices could be going down and when the bottom is going to be. And our expert today is Adam Taggart, host of the Wealthy On YouTube channel. How are you doing today, Adam?
I'm doing great, Nick. It's great to be back on your channel. I always have fun talking with you. And yeah, this is a really important topic.
Because right now there's a lot of confusion over the stock market. We have the bears who are saying there's going to be a crash. We have the bulls who are saying, well, no, we're just starting a bull market. What do you think is the truth? Where do you see the stock market going over the next 6 to 12 months?
To answer that question in full, let's go back for a moment to the level of overvaluations, because that's going to be one of the first dominoes that's going to start this cascade going. In terms of just how overvalued the markets are.
Right off the bat there, that's what's going to start this cascade. Wait a minute. We already started that. I don't know who this gentleman is, and I don't know how much he's in the market or not in the market, but just so that gentleman's aware, like, this cascade started a long time ago. This cascade started in February of 2021. Okay? That's like 20 months ago or some insane amount. Like, this has been ongoing for a long time, 21 months ago. I mean, we're talking a long time ago, this whole situation started. That's when the more growth-related names, the more speculative names, those all started falling. Then after that, it was more just small caps in general. Then it was mid caps in general. Then this year, it was large caps and just about everything else, okay?
We got a number of charts, but let me just start with a shortcut one that most people know, which is the Buffett indicator, right? Which is named after Warren Buffett. Sort of one of his cheats in trying to determine whether the markets are overvalued or undervalued. And what he does is he takes the market cap of the S&P, divides it by the GDP. Right now, the Buffett indicator is at 182%, which is historically very elevated. In fact, to get down to its historic trend line, it would have to fall by 43%. So we'd either have to magically goose economic growth, and we're going to talk in just a moment about how economic growth is actually contracting, so that's not going to happen, or...
Two things. One, Buffett is buying right now, based upon Berkshire's filings recently. They have been buying. Second part that I think is very important, as I don't think the Buffett indicator is the best thing to value the stock market on. I always feel like forward PEs are the best thing to value the stock market on. Now you can say, maybe a company's not going to earn as much money, so the forward PE is not accurate. Well, you could say the same thing about trailing 12-month PE. Just because a company earned X amount of dollars last year does not mean they're going to earn it again this year. They could earn far more than that. They could earn far less than that. So always look at forward PEs for the market and where things are trading at. I'll look at Yarndini, okay? So the latest numbers out here, S&P 500 large caps are about a 17.7, which is roughly where you kind of should be in this sort of environment, somewhere in there. You could say maybe we're on little upper ranges, feel more comfortable at like a 15, 16, fair play, okay? Mid caps are trading very undervalued right now. We're at a 12.9 forward P for S&P 400 mid caps. That's way undervalued. In small caps, I've been speaking about this for months and months and months now, are trading disgustingly undervalued right now. S&P 600 small caps are trading at 12.7, which is ridiculously low based upon any historical standard, over the past 20, 30 years, whatever, okay? So the reason those are trading so cheap is because everybody's so scared. And when people are really, really scared, they don't want to hold small caps. They don't want to hold anything more speculative. So they flood money into stocks like Apple, stocks like Microsoft, the sorts of things that people feel safe in, or even cash. Okay, so that's just important.
Asset prices have to come down, which is the much more likely outcome here.
I just think it's very important that people understand this because there's so much discussion.
Now, if we were to have 50% drop, and let's say the forward Ps are accurate, then we're talking about we're at like a 9, like a 9 for S&P 500 large caps. We're at like a 6 for S&P 400 mid caps, and for S&P 600 small caps, we'd be at like a 6, which is, all things are possible, but yeah.
About all the short-term movements, like what is the Fed going to do tomorrow? What was the jobs report like last month? But in reality, all of these short-term indicators pale in comparison to the large indicator that you just talked about, that the stock market is 45% overvalued according to an indicator that Warren Buffett uses. So let me ask you, Adam, what do you think the next shoe to drop is going to be?
Once again, Warren Buffett is buying right now, just so everybody's aware.
On the stock market, on the economy, what are the trends that we're seeing right now that have you concerned over the next couple months?
Okay, great question. If you're watching the markets closely these days, it's really hard to not pay attention to what the Fed is doing. Right after the pandemic, for the next year or so, year and a half, the Fed essentially put about $4.5 trillion of thin air, fresh new money into the system. That's an unprecedented amount of money. On top of that, Congress put another $5+ trillion of fiscal stimulus into the system. So we just had this tremendous tsunami of capital sloshing around, and it has to go somewhere, and a lot of that went into financial assets. So what's important about understanding that is both of those spigots have been turned off. The Fed is actually now gone into reverse. It's actually raising interest rates from their rock bottom lows, and it has started a process called quantitative tightening, where all of that stimulus it was putting into the system, it's actually now starting to claw back here. So those two things by themselves, mathematically, should be bringing asset prices down, and asset prices down pretty substantially.
Basically, it sounds like the training wheels are now off on the economy and financial markets, and that how high stock valuations have gotten, how high home prices have become, was a product of the long-term Federal Reserve intervention in lowering interest rates with quantitative easing and the lower short-term interest rates, as well as what you said about the $5 trillion in deficit spending that the U.S. government did. So now going forward, what's going to propel the economy into the future?
Rather than say training wheels, say like, imagine like a hot air balloon, right? And the balloonist, the Fed, has had the fire that puts hot air into the balloon just raging at maximum until recently. But now it's actually shut the flames off. So the balloon, what happens when you do that? Well, you would think the balloon would stop rising and maybe it actually might start sinking. And that's actually exactly what we're seeing, right? So if you look at the US GDP, it has contracted in both the first and second quarters of this year. The economic balloon is shrinking. And it's not just happening in the US, it's happening in all the major world economies. The IMF, in fact, they just put out their latest growth forecasts for the world. They had clocked 2021 GDP at 6.3%. For 2022, they're projecting a total global growth of just 3.2%. So that's an almost 50% decrease from just last.
Yeah, when you start talking about 6.3 numbers, that's you're overheating the economy, just flat out. Like, that's not usually sustainable. I mean, 2 to 4% would be pretty customary. So when you're getting to much bigger numbers, you have to comp those numbers year over year, and that's the part that no one ever talks about. You can't, in that situation, right? These 2021 numbers are impossible comps for these companies to comp against, right? And also government numbers. I mean, that's just ridiculous. It's no different than if you looked at oil price in 2020 and a lot of 2021, right? Unsustainably low. Like, oil price is not going to stay like that forever, right? So this year or over the past year, right, the economy opens up for real again, right? People start traveling, doing all those sorts of things. What happens? Oil price obviously goes up a lot, and because it was off such a low level, it makes it look like, oh my gosh, that's so high. Like, oil price is pretty much where it's been in many, many past years. It's not like oil price is magically so high now. It's just that the price of oil went up so much compared to where it was. Remember, price of oil was negative at one point in 2022. Negative. We've never seen anything like that. That's absolutely insane, right? So I just think that's something that's never stated enough, is those comps year over year, okay?
And they're projecting even lower in the twos for 2023.
So this is potentially a globally synchronized economic downturn and recession, a globally synchronized stock market crash and housing crash. We're going to talk more about this global aspect of this downturn, which you really need to be paying attention to, because there will be contagion, everyone. But before getting into that, I want to talk a little bit about the housing market, because you briefly addressed mortgage rates and the fact that mortgage rates have come off their lows of 2.8% about a year ago, and now they're around 5.2%. And basically, higher mortgage rates has helped bring the U.S. housing market to a screeching halt. Home sales are now at their lowest levels in nearly a decade. Inventory is spiking.
I think, see, even that's there's several factors there. I wish we could just chalk it all up to this one thing. Like, interest rates went up, so therefore no one's buying real estate. You had a massive pull forward in demand for real estate, right? You tack on, obviously, interest rates that are much more expensive if you're going to take out a home loan now at this point in time. That's going to hurt in a substantial way. And also, think about it from this context, right? People's confidence is very, very low this year in terms of everything. Like, you look at the Michigan consumer confidence, right? And going to buy a house is usually it is usually the biggest financial decision a person can ever make. So if your confidence is very low, then you're not as likely to go out there and buy, right? Once again, the interest rate situation and a huge pull forward of demand of a lot of people that already wanted to move already moved, right? And now aren't as inclined to move, and especially given all the uncertainty going on, right? None of that bodes well for real estate in the short term, at least, right? Now, those are short-term issues. Eventually, those can go away, but those are issues the real estate market is dealing with at the moment.
Across the U.S. housing market, we now have basically half the cities in the U.S. already seeing home price declines. Do you think this housing market downturn is an analog and a prediction for what's going to occur across the U.S. economy over the next couple of years?
Yes, I absolutely think that. And in many ways, I think what's happening in the U.S. economy is going to drive what's happening in the housing market. So I talked about the Fed hiking interest rates, right? So no surprise, mortgage rates are going up. The Fed is actually trying to engineer that, right? It's trying to increase a higher cost of capital. And as you know, Nick, it's just math. Mortgage rates go up, home prices have to come down. And we're going to get a lot more into this in the video we're going to do just on the housing market. That's going to come right after we record this video. So I won't give away all the secrets here yet. But, one key thing for folks to understand about what's going on right now in the main economy is, okay, so why is the Fed hiking interest rates? It's because of inflation, right? We have historically now very high inflation, the highest inflation in over 40 years. Inflation hurts companies. It hurts them because it increases the cost of their inputs. So all those additional costs are compressing profit margins. And usually consumers are buying less because prices are getting so high, consumers are having to tighten their belts. That all reduces corporate profits. So as corporate profits get reduced, well, what do corporations have to do? Well, they have to start laying off people, right? And also stock prices go down because corporate earnings are what drive stock prices.
This argument you're putting forth, Adam, about higher interest rates and lower consumer demand and lower corporate earnings.
What he just laid out there is exactly why the market has gone down so much this year, right? At the lows, the NASDAQ was down 34+%. As of right now, the NASDAQ's probably down about 20%-ish year to date. Russell's down about the same. And for that exact reason, basically on the back of earnings are expected to go down, and there's obviously a lot of fear out there right now.
Reduce stock prices further. This all makes so much sense. Like you said, it's just in the numbers, it's just in the data, but there seems to be a disconnect out there when you read the financial news, when you see what a lot of people who are bullish in the stock market and housing market are saying. Why on one hand do we have, for instance, consumers in America so bearish? Consumer sentiment is at an all-time low right now. A record number of people say it's a bad time to buy a house. But then on the other side of the equation, we have a lot of people in real estate and finance who are pretending like there's nothing bad going on, who are pretending like we're not in a recession. Can you explain this disconnect to me between the consumer and the regular American, and let's just say kind of maybe the elites who work in finance and real estate?
Yeah,
okay, in all due respect, Wall Street is very heavy on cash, shorts, and puts right now, okay, and have been here for the last few months. So I don't agree with that whole sentiment. Watch CNBC. I watch CNBC, okay? And almost every single person that goes on there is cautious or bearish. Almost every single one. The person that goes on there and is super bullish, non-existent, okay? The most bullish analyst on Wall Street has the S&P 500 going up 1% this year. 1%! You gotta be flipping my flapjacks. 1%? That's the most bullish? So I 100% disagree with this notion, that he's putting out there like, everybody's just so bullish right now and all these things. I'm like, no, not based upon the numbers, not based upon the facts and the data. And, for Reventure, he's a facts and numbers guy. And, it's just not the way things are right now.
There are two reasons for it, and the punchline is I think the consumer's right. But, there's that old quote by Upton Sinclair about, don't expect a man to understand something if his salary is dependent upon him not understanding it. So you have to, realize that the status quo, the whole system wants the status quo to continue. Everybody in Wall Street makes money with higher stock prices. Everybody in real estate makes more money with higher real estate price.
Goldman Sachs, one of their best years they ever had was 2009 for their net income. A tremendous number. Wall Street can make a fortune off of asset prices going down. Don't be confused for a second. If they position themselves correctly, they can absolutely make a fortune. So I just think, to think like the only way Wall Street makes money is by everything going up in price. That's just not accurate. So
higher home prices, more transactions. And so they're oftentimes the last people to tell you when the market is turning because they're desperately trying to keep the party going. That's, one big important reason is the folks that have been benefiting so much from, the everything bubble over the past decade. They don't want it to end. Part of that is they don't want to admit it to themselves, but they definitely don't want to admit to it publicly.
Right.
The second is sort of an analog at the national level where, this is an election year. We've got the midterm elections coming up in just less than 3 months. And the current party that's in power doesn't have a lot of strengths to run on right now. And so I think they're doing as much damage control as possible just in terms of the messaging. I think that's why you have so many kind of almost
And the other side, on the flip side, right, is going to point out how bad everything is and why it's the end of the world and why we need to get these people out of office. So that whole game he just talked about there, that works both ways. Let's never forget that, okay? Because eventually, your party's in office and then they have to deal with the same exact thing on the other side. Oh, they're doing such a bad job. It's the end of the world. This country's going to the poopers. And, it's the same thing across the board. So let's not act like it's only one side. They both play this game.
Ask like 1984 style discussions about even if whether we're in recession or not. Really, just a couple weeks ago, the technical definition of recession, there's a lot of ways to define it, but the technical definition of recession was 2 consecutive quarters of negative GDP growth. Well, we've just had that, but suddenly all of the administration economists are telling us, that's not really how you define one, and the media has picked up on that as well. I think both are under a lot of pressure from the current party that's in power in politics to say, look, you got to spin this as much sunshine as you can up until November 3rd so that we can get as many votes as possible. So that sounds quite cynical, but I do think that that's a component of what's going on here.
That's a really interesting take. And one thing I would offer to people is this is actually not a new situation. If you go back to 2007, 2008, just when the last recession started, but it was kind of unclear in late 07, early 08, if we were going to have a big crash, there was a very similar debate going on. If we were really in a recession, how bad would it be? Ben Bernanke, the Fed chair at the time, was out there in late 07 saying there's no recession, there's no housing crash. And then a year later, it became so obvious that they couldn't ignore it. But going back to the global perspective for a second, I think it's very interesting. If you look, for instance, at the Bank of England, they just came out a month ago and said to the people of England, there will be a bad recession starting at the end of 2022. So it seems like in different countries across the world, there's a lot more candor about the true reality of this situation. I'm wondering, do you think it's better for these leaders to be honest about the fact that there's going to be a recession and potential?
Yeah, I mean, Europe has a lot more to deal with in general. Obviously, because of conflict, Russia and Ukraine, we know about that. It's going to hurt them when it comes to energy prices even worse. Also, they're just not in as strong of a financial position as the United States is. They don't have the companies we have, and that's the biggest differentiation between Europe and the United States. Is just our companies are just so much bigger than their companies, so much more powerful than their companies, and where all the companies that really matter to the world are all located in the United States of America, right? Apple, Google, Microsoft, Amazon, Walmart, all these big dogs, right? The NVIDIAs, AMDs, Intels, all these companies are American corporations. All the companies that matter the most to the world are all American companies, right? And then outside of that, the next biggest group of companies that matter to the world would be some of the Chinese companies like Alibaba and some of those, right? Tencent. But I just think that's something to kind of consider, and that's why the U.S. just has this massive strength over the rest of the world, is because we have the dominant companies, right? Doesn't mean we can't get hurt. We absolutely can. It's just we're in a big position of power versus the rest of the world. It's not even close.
Make people have worse sentiment and spend less? Or do you think it's better for the central bankers and the politicians in America to be doing what they're doing and kind of have a more optimistic outlook?
Oh, God, I'm always on the side of more honesty. And I'll tell you, I've been in the business of interviewing people for a long time. And I've oftentimes interviewed people, people who are in high positions of power in government, corporate CEOs, et cetera, who you interview them on air and they tell you one story. And then as soon as the microphone's turned off, they say, okay, here's all the stuff I couldn't say, right? And what's tragic is a lot of people will use as a reason to refute concerns that you raise as, you know what, if this was really bad, we'd be hearing about it from our leaders. They're not saying anything about it, so I'm taking it that everything's okay. And I'm telling you that a lot of times the leaders are intentionally not sharing the information because they don't want to create panic, create a self-fulfilling prophecy. And I think that's what's going on with these other countries versus say like the U.S. The Fed is really the central bank that sets the tune.
It's kind of a part of leadership, man. If you've ever been in charge of anything, you have to keep everybody optimistic. That's just name of the game. Imagine you're the coach of a football team, right? And your quarterback breaks his leg and he's like your star player, right? You could be like, oh my gosh, guys, our season's over, right? We just lost our best player. Like he's broke his leg. We're done. We're finished, right? You're not going to be a coach for very long if you have that type of approach or attitude, right? You're going to be out of there pretty darn quick. Imagine being CEO of the company and you have a bad quarter and you're like, we're finished. This is bad. It's really bad. We're getting worse. Our company's so bad. We're not going to fix it, right? You're not going to be CEO too long. So as a leader, you always have to have that optimistic tone, or you're not a leader. You're going to be gone. That's just the way it is. And, if he's talking about political parties, they always are going to be optimistic, right? And unless they really have to be pessimistic and that's their only choice, they're always going to be optimistic.
Everybody else marches to. And so if the Fed came out and said, hey, everybody, we think recession's coming. We think you better tighten your pocketbooks. The entire world is going to go into, deliberate austerity. and start tightening their belts. And that's going to create the recession, maybe even in the Fed's mind, make it even worse or make it arrive faster than they'd like it to.
So it's an interesting point. Honesty is the best policy, but the Fed is in just a tough situation overall, and we're not likely to get a straight answer from them, which means for the people watching this who are trying to decide when to buy a house, when to buy stocks, you got to do your own research and look at the fundamentals. Like we talk about the Buffett indicator in terms of stock market valuation. One of my favorite indicators in terms of housing market valuation is inflation adjusted home prices. And right now, home prices adjusted for inflation and income are at their highest levels of all time, even higher than the 06-07 housing bubble, which is wild to think about, right? That's recognized as the peak of the biggest housing bubble of all time.
My favorite one that this gentleman actually uses is the one in which he shows like what an average income is for, let's say, a city versus how much an average home costs in that city. I think that one's actually a really, really good one. That's my personal favorite.
Okay. And yet home prices are more expensive today. And even though that's the situation, the conventional narrative has found a way to spin it like we're not in a housing bubble and there's not going to be a housing crash, which of course is already happening. We're seeing home prices go down in a lot of different cities already and inventory skyrocket. But back to the macro economy for a second, because in the end, the housing market, the stock market, it is all going to go where the macro economy goes. Right now, Adam, are there certain indicators you're looking at in real time to tell you if there's softening in the economy or if the recession is getting worse? Maybe it's layoffs, maybe it's consumer spending. What are you looking at, and what should our viewers out there be looking at to get a better understanding of where the economy is heading over the next 6 months?
I look at a lot of the consumer household stats. So we look at, obviously inflation and cost of living. Is that getting better? Is it getting worse for households? Right now, we're still in a place where cost of living is continuing to grow at an unacceptably high rate. So that pinches consumer household budgets. Real wages have not kept pace. As you mentioned earlier, Nick, they've gone down. I've lost count of how many consecutive months real wages have continued to decline, but it's like over 15 or 16 months at this point in time. So here's one of the key indicators. Let me just mention this one last one. I'll let you go. During the pandemic, when people were getting those stimulus checks, we actually saw a drop in consumer credit. We saw that people were actually paying off their revolving credit instruments like their credit cards. Well, that has done a complete U-turn, and we're now back at record highs in terms of outstanding revolving consumer credit. So what we're seeing is that the consumer household is getting more and more desperate, that it's financing more and more of its monthly living costs on plastic right now. And as you and I know, that has an end date somewhere where the credit card companies cut you off.
So basically, it sounds like American consumers don't have enough money. We've had crazy inflation.
Well, don't worry. Stimmy's coming, baby. Yeah, I covered that in a video on the main channel a few days ago on the unbelievable amount of stimulus that is about to come to folks over the next 6 to 12 months. In terms of stimulus, in terms of tax money coming back, there's so many various things going on out there. Student debt being canceled. There's a lot that's going on right now as far as that whole game.
For 2 years, the wages haven't kept up, and now they're putting more and more money on their credit cards. And I think a lot of people can relate to that argument, right? It's very clear that American consumers don't.
Just wait to the next thing. The next thing that's going to happen is it'll be a few years from now, essentially. But what they're going to do is they'll say all these greedy credit card companies have been charging way too much interest. It's such a scam. So if you got any credit card debt that you had to pay more than 20% interest on, we're going to cancel that for you. Just wait for that one, man. You think it might not happen, but you'd be surprised at how these things happen. Look at the student loan stuff. It's like, here's $10,000 off your student loans. We can laugh at these things and act like they're not possibilities, but just wait. Wait to see the 40-year mortgage.
Have much money and that they're really being strapped. But I think someone who would be more bullish on the economy, the stock market, and housing market would say, okay, Adam, I see that, but I also look at a job market that's one of the strongest job markets of all time. When you look at the unemployment rate of 3.5%, it's near a record low. When you look at the number of job openings, we have over 10 million job openings. So even though consumers are getting pinched on spending, the job market is still strong. So isn't that going to mean that the economy is going to keep going and keep growing into the future?
So I'm so glad you asked that question. I have a weekly market recap with Lance Roberts, who's a very experienced financial advisor. And he summed up the markets really well recently. He said, you know what? He said, all of the technicals are bullish, but he said all of the fundamentals are bearish. And basically what that means is if you look at the price action of the stock, it's exhibiting patterns that you tend to see in a bull market. But if you look at the fundamentals and try to find out, okay, so what's causing stocks to go up? There's absolutely nothing that you can find there that justifies what the stock market's doing.
So the stock market's playing a little bit in the future, okay? Same exact thing we could have said in March of 2020, but way, way worse, right? You could have said, look at unemployment skyrocketing to the highest numbers since the Great Depression, right? People aren't making any money. We're shutting down the economy. Money velocities, going through the floor right now. Companies are highly leveraged in some industries, and those companies aren't going to have access to capital. Like, there's so many various things we could have went through at that time, right? Way worse than right now. Not even close, right? That's a whole different game if you're talking about closing down the economy. And what we ended up seeing is a year later, record earnings for companies, right? Record job market, like record pretty much everything, right? And then obviously high inflation on top of all that. So, I just think that's a tough game to play in terms of things look bleak. Things look bleak in 2009 as well, really, really bleak. And stock market started to rally, and people are like, this is ridiculous. Why is the stock market starting to go up? And earnings started coming back in the back half of 2009 and into 2010 for companies, and no one really saw it coming. So, is it out of the realm of possibility that earnings start coming back strong in 23? It's not out of the realm of possibility. I wouldn't bank on it, but to say it's not possible is a little mistake, I would say.
I might say, I know some people who are like this. They say, well, the unemployment rate is 3.5%. We added 530,000 jobs in July. So that means I should buy stocks because the economy is doing well. Like, what would you say to someone who has that argument?
Glad you called out that payrolls report, which was the last payroll report from the Bureau of Labor and Statistics. There's literally almost no other data point that agrees with that incredibly rosy payrolls report that was issued a few weeks ago. And there's many people out there, and I count myself one of them, who are kind of looking at that as window dressing that's being used to sell a sunnier story than actually is reality on the ground. And, Nick, you and I have talked, and I've got a long list, I'll spare folks from going through it here, but about the fact that companies are not just tightening their belts by, issuing hiring freezes. We're actually seeing real layoffs at real scale starting already across a huge swath of many different sectors in the economy. So it's kind of one of these deals where, like, the guy on the TV is telling you that it's sunny outside, but you're looking out your window and you're seeing the thunder, lightning, and rain.
I just want to say I love that analogy. Again, it seems like there's that disconnect between what people are reporting in the financial institutions and the government, and then what people are feeling on the ground. And let's just talk a bit more about those layoffs. What are some of the companies now over the last couple of months that have announced layoffs?
So here's a good example, right, where we're being told that it's a super strong economy. There's nothing to worry about. Okay, here's just a quick Google search that I did yesterday, and this was probably maybe 4 minutes of searching across Google. Wayfair just announced that they're laying off 5% of their staff. Peloton's laying off over 4,000 workers. Shopify's laying off over 1,000. 7-Eleven is letting go almost 1,000 management positions. Tesla announced that they're laying off 10% of their employees. Ford is laying off over 8,000. Remax, a realty firm, laying off.
And this is a very healthy thing for the long term of these companies. These companies got a lot of dead weight, man. A lot of dead weight. You got to get rid of the dead weight, and you got to get your company in a position of power, to be a more profitable company. Something we watched in 08, 09 is what came out of that is more profitable companies than we've ever seen at any point in history. And one of the reasons is companies hired more appropriately coming out of that because they were a little timid. They were a little scared, right? And it wasn't necessarily the best thing for the employment market or wages over those coming years coming out. But what we witnessed is companies reach profitability levels. You look at some of these companies' profitability nowadays. It was never thought companies could make this much money on their bottom lines. And so it is a healthy process that you do have to go through. It makes unemployment potentially go up. It depends, maybe not in this environment, but it can make unemployment go up. But it's better for the long term of these companies because that's just how it is, man. when you get into one of these environments, when the stock market goes down a ton and things like that, you have a good excuse. And when your revenue is not skyrocketing, you have a good excuse to get rid of a bunch of workers. If your revenue is going to the moon, right, and everything's going great and the stock market's flying high, it's very tough to say I'm going to cut 10% of my staff. People are like, what? You're going to cut 10% of your staff in this environment? However, on a year like this, where the stock market was tanking through the floor, you got all the geopolitical worries, you got everything that's going on, all the fears, revenue growth slowing, companies' earnings, some of them going down year over year. Perfect environment to say we're going to cut 10% of our staff, 5% of our staff, 15% of our staff, or whatever. So just do keep that in mind. Whoa, I went big. I didn't want to go that big, man.
17% of its force. Carvana's laying off 2,500 people. Netflix and PayPal have undisclosed layoffs. And just to note one company too. So Amazon, in Q2, Amazon laid off 100,000 workers. It's 100,000 workers at just a single company. Folks that are telling you that everything's great out there, you look at the real data, it's really not.
I was shocked at how broad-based.
Amazon was one of several big tech companies that have hoarded workers. I mean, absolutely hoarded them because of the numbers they were doing. And e-commerce has been one of the things that's been hit the worst in all this. We've heard it from not just Amazon, Shopify, Affirm's numbers, like across the board. Anything e-commerce related been hit hard.
Meta. It's big companies, it's small companies, it's tech, it's real estate, it's banking. It's happening across the economy. And I suspect it's going to take some time for those announced layoffs to filter their way into the jobs report, but they definitely will at some point. And I also think, and you can tell me if you agree, I think these layoffs are just beginning, because when I look at what the CEO of Peloton said, it was very striking to me. After they announced the layoffs, he said in a letter to his employees that they will be going back into the office in November. And he made sure to underline that if anyone had a problem with Peloton, going back into the office, if any employees didn't want to come, he said, well, sorry. See you later.
That's how fast the companies have gone back into the position of power. You go back a year ago, employees were in a full position of power. Everybody was trying to hoard workers like we talked about. You could get any wages, things like that a year ago, year and a half ago. Very different environment now. Very, very different environment. When things get tough, the companies go back in that position of power once again.
But you're not going to be working here anymore. And so I'm wondering, are some of these corporate CEOs going to use the move back into the office as almost a stealth layoff to get people to quit?
Oh, absolutely. And another major employer, Apple, is right in the middle of doing the same thing right now. It's been big in the news this week. So I think it's absolutely a tactic that they're using to do it, where they don't come out looking like the bad guy, like, well, we just did an across the board layoff. We gave you a choice and you chose not to come back into the office. Just like the housing market exhibits several stages before you just jump to price cuts, right? Where you see, listings increase, you see listings get pulled as people don't get, the prices they want. They'll do everything they can. They'll throw benefits out there, et cetera, do everything they can before they start bringing down prices. Very similar in the job market. Companies are slow to hire and they're slow to fire. And employees cost a lot to find, to train, and to retain. And so companies don't want to willy-nilly fire them. And so usually you have hiring freezes first, and then you have bonus cuts or hours cuts or contractor cuts. And only then after that, as sort of a last resort, companies start laying people off. And that's why I'm so surprised that we're seeing this many layoffs across this much of the economy this soon, Nick, because I think that, we are still in the very early innings. I mean, I might even say the first inning, or maybe the top of the second at most, in terms of the type of economic slowdown that the data is suggesting is coming ahead. So if we're already seeing these kind of layoffs right now, I think very, very conservatively, we can assume that when the recession that it looks like we're heading into arrives in full force, we're going to see the same scale of layoffs that we saw in 2008 or back in 2001, which is hundreds of thousands of people losing their jobs month after month after month. It's millions of layoffs in totality. And, I just worry because so many households right now are kind of hanging on by their fingernails. And these are still kind of quote unquote good times in a good job market. It's going to be much more painful 6 to 9 months down the road. And I think that's why these conversations are so important, both just about, what's happening with the markets, but also what's happening with housing is we're hopefully giving people advance warning so that they can take preparations today to make themselves less vulnerable to the impact that may be coming down the road.
What makes me concerned about that projection you just had is that I'm thinking about what's the impact going to be on the housing market, because already home sales are now at their lowest level in 8 years. Already home prices are going down in half the country. So then if you introduce wide scale mass layoffs into the picture 6 to 9 months from now, that's going to mean the housing market crash is also just beginning, and home prices are going to...
Yeah, if you get mass layoffs and those jobs are not fulfilled, that's a messy situation. Then you get a 2007 through 2009 situation there, right? But the big question is, does that happen? And I think far too many people are way too confident that that is going to be exactly how this plays out, and we're going to have unemployment go to 10% plus, and if people lose jobs, they're not going to be able to find jobs anywhere else, and we're going to end up in the banking system's going to fail, and all those sorts of things. And yeah, I think that's just a little too confident. Let's just call it that. A little too confident to predict, but I think the problem with '08 is it screwed up everybody's minds, and now everybody thinks that's what happens in a recession. You're going to get all the indexes to go down 50+%. You're going to get real estate to go down 30, 40, 50% in the hot markets. And it's just that sort of devastation. When we can get a recession in which unemployment goes up, real estate prices come down, stocks come down as they already have, right? But it's not to those sorts of levels, right? I just think everybody just sees that as being the last real recession. They say, oh, this is a real recession, therefore that's going to happen, right? And never underestimate what the government will do and what the Fed will do and what states will do. And if they get into trouble, they will do whatever it takes. If that means having no one pay their mortgage who makes under $100K a year, they'll do it. That's the part that I think everybody forgets. We're in a different economic time. And the thing that happened in '07 is it introduced something into the system that we've never, ever seen before. And that thing was the ability for the government to say, we will bail out the economy, we will bail out whoever, if we feel like it's enough of a risk to take the whole system under. And they will do whatever it takes. That means they have to say no one has to pay their car loan. They'll do it. They will do whatever it takes. And don't underestimate them. And the agenda just gets pushed more and more over time, right? I think the whole student loan thing is a step in that direction in the most massive scale we've ever seen. The stimulus checks being sent out during Rona was a huge step in that direction. The student loan thing, the $10,000, is even a bigger step in that direction toward potentially universal income over time. And what they're doing is they're just testing things one by one, seeing how it affects things. Oh, this is making inflation go up. Oh, this is helping out the economy and bringing down unemployment. They're doing a lot of tests right now. And everything's moving in the direction of likely universal income and likely the government just doing whatever it takes to keep the show always going. And, if you're thinking they won't, you're mistaken, because they will do whatever it takes. So anyways, guys, much love as always. I appreciate you joining me for this beast of a video. Not many this long, but I thought it was worth talking about. It's interesting points. I agreed with a lot of the points they made. I disagreed with some as well. Much love and have a great day.